It's Thursday, that means it's time for another Commodities Corner interview. On today's agenda, oil. Desmond Chua is on the phone now. Desmond, when CMC Markets spoke to Dukascopy TV in March, we discussed how the Ukraine crisis was bolstering the US oil and gas boom. 2 months on, what picture are we seeing now?
Well, just yesterday we saw renewed talks of de-escalating the current conflict in Ukraine, and that has definitely helped to temper oil prices today. However, I do think the risk premium, or rather that the risk remains as long as Russian troops remain at the border of eastern Ukraine, while a referendum carries out as planned on the 11th of May. And that may risk further retaliation from Gulf forces. So therefore, the recent ease in oil prices may prove to be transitory, and any risk of conflict may support an oil risk premium in the shorter term.
It was reported this week that most Asian countries have not built up sufficient reserves to absorb a supply disruption amidst the region's growing dependence on Middle Eastern oil. With US stockpiles also noting a decline this week, is back supply an issue at present?
Asia accounts for about 75% of oil exports from the Middle East, and this in turn is actually about 50% of oil demand in Asia. So with such a high reliance on Middle East exports, there may be instances of a supply shock if we get recurring threats of shutting the Straits of Hormuz or even Libyan disruptions in that sense. So sudden disruptions may hit nations with low reserves, as the supplies from Americas may actually take much longer to ship. Therefore, in the near term, we do also do think that prices may actually be supported, especially if the recent sanctions on Russia lead to a tit-for-tat situation where energy supplies to Europe may be disrupted, turning European demand further towards squeezed Middle Eastern supplies.
Next up, over in North America, US crude oil production was reported at its highest monthly figure in more than 20 years. That's according to a report by EIA. While in Canada, a surge in prices is narrowing the gap between Canadian oil prices and US crude. Is this a positive for Canadian refiners? And how happy will their US peers be about this development? Could this benefit the region as a whole?
Well, I think the recent run-up in prices of the Canadian benchmark may be due to the opening of the Gulf Coast extension, or rather the third Keystone pipeline. And this pipeline essentially opens up supplies from the Midwest to further south in Texas and Louisiana, relieving choke points previously formed by transportation issues. I do think this is actually a boon for both Canadian producers and U.S. refiners, as the Canadian producers would have benefited from the price increase, while refiners in the U.S. has more alternatives with less reliance on imports from other areas which are further away. So, but in the meantime, however, refiners may still prefer the WTI benchmark, given a nearer proximity, as well as going through the current record stockpiles as reported by the EIA.
With all that we've discussed in mind then, how do these events shape your forecasts? And are there any other items we should be considering in crude oil trade?
Yeah, with all that said, I do think certain market conditions are currently supportive for crude oil in the near term. If we think about the risk of escalating geopolitical tensions in Ukrainian Russo countries, as well as Western Middle Eastern conflicts, that runs the risk of disrupting oil supplies, supporting oil premiums. We may also see reduction in stockpiles, as we are starting to see oil companies stocking up ahead of the driving season in the U.S. Meanwhile, I do think improving economic conditions in China and the U.S. Also means consumer demand may pick up from the largest two consumer nations, therefore further supporting oil prices.
Desmond, great as always to hear your thoughts. That's all from me for now. Sophia Aribo will be back shortly to see what ECB President Mario Draghi has to say in today's press conference. Goodbye.